Analysis is one part of trading, but how you plan the setups is what matters the most because that's where the money is made or where the money is lost. After this video, you'll be able to use analysis to build profitable trading setups, just like this one. If you watch a market from one higher time frame trend and observe a market structure that forms an uptrend, with basically higher highs and higher lows, the natural and usual expectation would be for you to believe that the market is about to continue what it already has done, and that is not wrong. But the disadvantage is that if you're in such a high time frame, it will take many days for you to enter a trade, and then many more days for the trade to end. And that is why we only use the high time frame trend by doing the market structure analysis inside of it. But the setups and entry models will be taken by using the lower time frames. For that, we must understand that during a high time frame impulse upside move, we have many small uptrends on forming higher highs and higher lows on the low time frames. Then eventually the last low time frame lower high breaks down, and that would be an internal market structure shift. You should know what they are. We've talked about these many times on my channel. So anyway, the point is that eventually that reverses the trend into a downtrend. But beware, because it reverses the trend into a low time frame downtrend, forming lower lows and lower highs. But this entire downtrend is just a low time frame one, and a low time frame downtrend during a high time frame uptrend is just a pullback to basically rebalance the market, break the last higher lows. Which again sets an internal market structure shift, and this shift aligns both trends together, basically moving to the upside to continue the high time frame uptrend. And a similar directional movement happens next. It's what holds an uptrend. For an uptrend to be held, it also needs pullbacks to rebalance the market and gather more liquidity. The market can't just go straight to the upside forever, because that would not be an efficient market anymore, and there would be sellers to close the positions of the buyers. So right now, the market is approaching swing low. As long as the market holds above the swing low, the market still follows an uptrend. If it does break, we flip our bias into a high time frame downtrend, and we've got a break. So a market structure shift on the swing levels. Now what we would expect is a formation of lower highs from where it will probably reject since we've flipped into a bearish trend, and the rejection usually comes from a supply near the highest levels. This supply taking the market into swing lower lows. But what we are talking about is on the extreme swing levels. And the problem traders face is that they don't want to wait hours, days, or weeks for this setup to actually happen. So what we're going to do instead is trading the low time frame trend alignment with the high time frame trend. I will explain soon how that can be done. But first, we see here that we've got an internal market structure shift, the market basically breaking up above the last low time frame internal lower high, which formed an internal higher high. So what we would expect now is that the low time frame trend should follow an uptrend by forming a higher low, then higher high, all the way up near the swing highs, but not above the swing highs because the high time frame trend is still bearish. It's just the low time frame trend that is bullish. And we can actually trade against the high time frame trend. What we will basically do is trading a pullback. So if we're expecting a higher low to be formed, that itself should be the entry model for a buy position. And why a buy position? Well, we're trading this pullback on the lower time frames. We are just expecting that the market should go higher in the lower time frames, but not in the higher one. In order to identify this potential higher low, we can look for a support or a demand zone in this certain time frame. Here it's simple to observe because it should be near these lows. But we don't use this zone to trade from. We just use it so we can later refine this zone into a higher quality one once the price moves near this level. And now what we do is we switch into a lower time frame. This is the 5-minute chart. Now if the market would have to break this high, as it should since we've reversed into an uptrend, this would validate the break of structure. Basically just a small indication that the market has a higher chance of going to the upside compared to going to the downside. But for now, we wait and see how the price moves so we can respond accordingly. So it has broken to the upside here, but did not fill the downside support or demand yet, but now it's getting closer to the zone, so it might be able to fill the zone. Great. And now what we want to see is a reaction. There you go. A bullish reaction out of the zone. So we mark the demand zone being the last bearish candle before the upside impulse. And this is where we take the buy position from. Stop loss below the demand. And we have multiple options for the take profit. We can place it above these lower highs, or we can place it on invalid supply zones. This way, we are taking the liquidity from opposite side traders. They are traders that are trading against the trend, or they are not aware that this market is still bullish, but they're looking to sell the market instead. The exit target depends on the risk to reward ratio. If it's way too high, and in this case it might be, then we look for a supply zone on the lower levels, for example this one. And the risk to reward ratio is still great here, not too high, but also not too small. Now we just wait for the market to react. Position got filled. We're still holding a bullish momentum. And that was it. Let's watch another one. This is a FX pair, the euro against the US dollar, on the 15-minute chart. We see here a massive descending trend, basically a long-term downtrend. Downtrend that is formed with constant lower highs and constant lower lows. So in this case, the simplest form of trading is selling the lower highs and taking profit into lower lows. But if that was done here, this would have been a loss after a while. Since the market broke above the previous lower high, this is what we call being as a market structure shift. And being on the main time frame that we've done the main analysis on, this is an external market structure shift. An external market structure shift is the first major signal that the market has a high chance of reversing into an uptrend. And because it is external, it means that the reversal should happen on this main time frame. What we usually do in this cases is we now look for a demand zone near the lows. For example, this one, and we're looking to snipe a buy-long position, basically expecting the market slowly pulling back into the demand and rejecting right back to the upside. Move that should form a bullish break of structure. That is just a way of saying that the market is holding a bullish continuation on this main time frame. Now here we actually got the break of structure before filling the demand. That is not what we want to see. And eventually it closes with a loss. But no problem. As long as you sustain a positive risk to reward and you are able to analyze the market, even if you lose like 3 trades and you win 1, you'll probably still end up net positive. So let's keep going. So what happened is that we got trapped. It happens, and it's not realistic to avoid all of these traps, especially that the market structure was playing to our side. But it eventually moved into lower lows, continuing the downtrend in the short term. So now that it has broken down below the lower lows, after an important break of structure, most of the times a pullback forms to rebalance the market and take out some more resting liquidity, which looks like it is happening right now. But here we see an important price action, so we got the pullback. Then the market tried to move into lower lows once again, but this time it failed to do so, and instead it formed a higher low. Also considering the fact that this higher low has bounced right to the upside from a demand zone, we have some confirmation that the market is currently following a short-term uptrend. And we're pretty late for this position, but this is just to see if the market holds this bullish continuation so we can take other trades after. And yes, it did manage to hold this buying pressure from the demand. Now this validates a new demand, which is exactly this higher low. Remember, the demands are often met in chain effect one after another on the higher lows. But for this demand to actually validate, we would need the market to break above these swing highs, which would revert the trend into a high time frame uptrend while also having a low time frame uptrend. Both trends aligned with each other, this highly increases the chances that the demand will hold. Great. So we've confirmed the bullish market structure shift. Now we want to wait for the market to pull back into the demand. Now that's close to the demand. We switch into a low time frame to refine the setup into the 5-minute chart. So far the market consolidates above the demand. We need some patience. The market is still likely headed towards the demand as long as the price does not break above these swing highs, because if it does break above, the demand will likely not fill. Here we need to be careful since it's been going up, but as long as it doesn't break the swing highs, the market is still on low time frame downtrend. We're getting close here, and the demand got filled. Now what we want to do is to refine the setup by looking for an entry opportunity on a lower time frame. This way we can snipe a better risk to reward from the 5 minutes going into the 1-minute chart. Here we see that the market has hit the demand and instantly bounced up. So now we have proof that this demand has many resting orders and it should respect. But for that we need to plan the entry. And to plan the entry we need 2 things. A confirmation of this reversal, which would happen if the market would break these highs by forming higher highs, therefore a market structure shift. And we also have a bearish break of structure that might get validated in the short term. and the break of structure was first to be hit. Then the market moved into new highs, breaking above them. So now this break of structure becomes a liquidity sweep. And having another confirmation that this trend is bullish from the trend shift itself, we can now look for a demand near the lows. And here, it's pretty easy to observe it, right here. So managing the setup, entry on the demand, stop loss below the refined demand, and we can look for a higher risk to reward ratio here because we've done such a deep analysis. But still not too high, like targeting these highs. This is a 1-to-9 ratio, way too much. But about here should be fine. I chose this level because there is an imbalance, if you notice. Should be the highest target I'd go for. And now we just have patience. Almost got stopped out, but then quickly reversed to the upside, eventually closing the position as a win. So as a quick summary, we choose one main time frame, can be any. Let's say that this is the 15 minutes one. If this market follows a downtrend, so having constantly formed lower highs and lower lows, we wait for the market to break the last swing lower high. This forms a new swing higher high. Therefore, a market structure shift. This trend shift validates a demand or a support level near the extreme swing lows. And what we want to do is to lower the time frame one time. So for example, from the 15-minute time frame, we zoom into the 5-minute time frame, and we wait for the price to fill the main high time frame demand or support. But we don't trade from this level, but instead we want to see that the market prints a bullish reaction. In case when it does, we zoom into a lower time frame once again. So from the 5 minutes into 1 minute, then we want to see the market either taking liquidity from the lows with a wick and instantly rejecting back to the upside, eventually breaking the low time frame highs, or forming a higher low, which eventually can lead into breaking the highs. This break of the highs form an internal market structure shift in this specific time frame. When we have that validated, we look for a demand zone in this specific time frame, and we look for buy-long setups, taking the market into either low time frame higher highs or high time frame higher highs, depending on your risk tolerance, but as I said before, don't go too high on the risk-reward ratio. Now there is also another case, but we did not meet this situation on our trades. That is simply the opposite of what happened. So we choose the main time frame. Let's say it's the 15-minute one. If this market follows an uptrend, so basically having higher highs and higher low formations, we wait until the market breaks down below the last higher low. This forms a lower low and breaks away from uptrend, reversing it into a downtrend by having created a market structure shift towards the bearish side. Then we look for a supply or a resistance near the swing highs of this 15-minute time frame, and we wait for the market to pull back into the supply. Moment where we will zoom one time into a lower time frame, let's say the 5 minutes one. And we want to see a bearish reaction out of the supply. Then we switch once again into a lower time frame, let's say into the 1-minute time frame. And here we want to see a downside move that breaks below the last internal low. So basically forming an internal market structure shift. At that point, we want to look for a supply or resistance near the highs in this 1-minute time frame, selling short on that supply, with the stop loss above the supply. And take profit according to your desired targets. But make sure to keep a healthy and sustainable risk-reward ratio. We did not find this type of setup because the markets during this time of recording were just being bullish, after weeks of downtrends. So in this period of time, buying setups made some more sense than selling setups. But if you're looking to learn trading in a similar way, where you can analyze the market this way, you can take a look on the link in the description. I have many more materials like this, and even more, you also receive an ebook on how to stop destructive trading. It's pretty interesting and simple to understand. So feel free to take a look, and we'll meet on the next video. Thank you for watching.